Let's start with our economic data this week. Throughout the week leading up to that big red number we saw in the jobs report. Earlier in the week, we got ISM for both manufacturing and services. For manufacturing, the headline number was down above expectations, but down not by much, 52.6 to 52.4. What is promising here? Employment up 48.8, up from 48.1, but new orders are down and prices way up. Look at that, 70.5 up from 59. This is for February. I wonder if that had to do with the 15% overall tariff. Everybody gets tariffs now. For services, big jump up, 53.8 to 56.1. Business activity, 57.4, jumps to 59.9. Even employment coming along here, 51.8, up from 50. New orders, that's a big jump, 53.1 to 58.6, and prices down. Well, that's nice to see there. Challenger job cuts fell into a more normal range, 48.3, down from 108 last month. Something that doesn't get enough press, I think. Export prices, import prices. You would expect that if tariffs were causing a lot of grief, that our import prices would be very high and export prices low. But it is opposite. Export prices month over month for January up 0.6. Import prices only 0.2, which equals what we saw in December and hit expectation as well. If you look year over year, for export prices up 2.6%. That is down from the month before, which registered an annual rate of 3.4%, 2.6. But look at import prices year over year for January, negative 0.1. Import prices year over year for last January, the guy was just taking office. Nothing had happened yet. This January, tariffs everywhere. You can't even count them. Import prices negative 0.1. Not enough press on this one, I think. Initial jobless claims pretty much flat. Week over week, expectation was for 215. Call it 215. We're at 213. I expect this to get revised. This is a preliminary look at non-farm productivity and unit labor costs from Q4. Preliminary because we only have the preliminary look at Q4 GDP, and there are revisions to job numbers coming in. Productivity is a residual. It is just taking two numbers, dividing them, and saying, "Oh well, this is what productivity must have been," because that's how it's measured. 2.8% for non-farm productivity. You had a lower GDP read, down from 5.2, and that brings your unit labor costs upwards. The lower your productivity, the higher your unit labor costs. 2.8%. It was negative in the quarter before, but again, I say this is preliminary. We'll get two more looks at this one, an advanced and the final. Okay, ADP. We saw this on Wednesday. 63,000. The expectation was for 53. So after the two ISMs showing both increases in the employment index within them, and ADP, ZQ decided, look at the price of oil, look at the price of gas, look at jobs. You're not getting rate cuts. In fact, by Friday morning at 8:25, 5 minutes before the jobs report was released, the May ZQ contract had priced out 33 basis points in 1 week, actually 4 days of trading, because we hadn't even started Friday, priced out 33 basis points of cuts on energy prices. And the Fed looks at core PCE, which strips out energy and food. Now, I know that energy bleeds into a lot of different things, but not that fast. 33 basis points in 1 week. It never gives us 33 in 1 week, but by God, it takes it away. You'd almost think the market was the IRS. Anyways, non-farm payrolls, when this number hit, I went ballistic. Are you seeing this? Negative 92. Talk about a miss across the board. Expectation for 59. Bigger number and a different sign altogether, negative 92. So, of course, you got to go looking through the documentation to see where that is, because if the private sector added 100,000 jobs but government lost 200,000 jobs, well, that's actually a pretty good thing. You don't want to see 200,000 people go, but that's taxpayer dollars that are now being saved. So you got to go and dig and say, well, where is it? It was broad-based. It was across the board. It didn't favor one sector or another. In fact, in the goods-producing sector, all the high-level categories, all of them were negative. All of them. Negative 92. Unemployment rate up to 4.4. You could almost call it 4.5. Had you held the participation rate constant, it would have easily registered a 4.5, but your participation rate dropped. And when people drop out of the workforce, well, they're not in the labor force anymore. They don't count as unemployed. You can get this number way down if you can just talk to everyone who doesn't have a job and say, why don't you give up? I mean, look at yourself. Who's going to hire you? Just give up. And you could do a lot. I'm surprised there isn't a department of discouragement that you could just hire one person to put out a YouTube video and, a regular YouTube video for the unemployed. Look at you. Who would hire you? No one likes you. You should just give up. It wouldn't cost much either. Average hourly earnings, 0.404. This is going to become, let's say meaningless as far as inflation is concerned. And I do expect that number to increase, that by the time we look at this next year, that 0.4 will be small, I think. I think that number will be bigger because as AI makes non-experts almost redundant, you could take the bottom 10% of the workforce right now and say, never mind about churn in the bottom 10%. Let's talk about elimination of the bottom 10%. So more wages will accrue to expertise. So I expect this number to rise over time, reflecting just the shift in who's getting paid what. Those who are experts in their field and who use AI will be worth a lot more to organizations than than non-experts at lower cognitive domains who don't use AI. So this number here, I think, is going to matter less and less and less for wage inflation, and will reflect more and more and more the structural shift in the workforce due to AI. What else have we got here? Government payrolls down 6. That's always a good thing, right? That's taxpayer dollars being saved right there. Manufacturing down 12. I thought trillions and trillions were pouring into the country and we're bringing manufacturing back, but it is almost, with all the revisions we had for December now, it is almost every single month manufacturing has been losing jobs. And this is consistent with what I've said a year ago, that you can try to bring back manufacturing jobs, but manufacturing jobs in North America were not lost to China. They were being lost to automation. What stopped the loss to automation was China was cheaper. It was labor in China was cheaper. Okay, well then let's not use automation, let's use labor in China. Had China never come along, had it never entered the World Trade Organization, you'd still be right where you are, just with a hell of a lot more automation. These jobs are not coming back. Jobs for building the robots to eliminate the jobs are coming back. Manufacturing down 12, non-farm down 86. So if we dig a little deeper, look at our revisions. December, that's a big revision down by 65,000. It now showed a negative number. So the last press conference we had with Powell saying at the end of the year the jobs market showed a small rebound. Well, now he's got to backtrack that. No, it didn't show a rebound. It actually degraded into the end of the year. I wonder if he'll change his mind, if he'll update his model, or if he'll just ignore it. I don't know about Powell. I think it is time for him to go. It is time for him to go, and circumstance has created a situation where he'll be remembered as doing a good job, but meeting by meeting, I don't agree with many of the decisions he makes. January down 4, but we have another revision for January coming. Right, once we get the March job numbers in April, there'll be a revision to January and February. And since revisions have always been negative, this negative 92 is probably set to be an even bigger negative 92. Household employment down 185,000. Unemployment up 203,000. And we can see here high school and less than high school down, BA and greater than BA up. That's what I'm talking about for the average hourly earnings, is as you have a shift more towards expertise, you will get that relic in average hourly earnings that is more a reflection of that transition than wage inflation. Establishment in the goods for the jobs, we had the number here, 92. Goods, all sectors less than zero, all lost. And healthcare down 18.6. The losses were all broad-based. At the same time, retail sales came out. It didn't get as much press as it should for January, negative 0.2%. February's probably not going to be much better because of the weather issues that you had in February, the cold weather as reflected in the nat gas futures that were on fire. Zero for December, and then you were down from that zero number as well. Retail sales ex autos 0%, ex autos ex gas up 0.3. So I guess that's something to look forward to, except now gas is going to take it away. You went from, I think some places might have been a little under $3 a gallon to something a gallon. Wholesale got down to $2.13. So in a place like Texas, you might have seen $2.65, $2.60, $2.65. Probably pushing up to $3.50 to $3.75 now. In a favorable delivery state like Oklahoma or Texas, $17, $18 a gallon in California and New York. Let's have a look at the effect on rates and yields. Rates up to about the 3 to 4 month is going to be very well behaved. They'll follow wherever the effective federal funds rate is. You got some movement in the 6 month to 1 year. Some basis points coming out. It's the long end of the curve where basis points have really come out week over week. And in a word, that is Iran. Is it Iran or Iran? I don't know. Still, though, for the year, it is lower now than it was at the beginning of the year for the longer end of the curve. The 2 to 10, unchanged for the week, but is flatter year to date. Same with the 3 month to 10 year. It is flatter, so we do have a flatter curve, not a steeper curve. So KRE did not have a good week, and year to date, almost all its return is now gone. The market is pricing cuts out. That is not good for KRE. A flatter curve, not good for KRE. And mounting credit concerns, not good for KRE. All of these things are negative. We want KRE to perform. We need the real belief that we're going to get money market rates down, the real belief that the yield curve will steepen, and that the credit concerns we're seeing are very well contained with the PE platforms. Just bad all across the board. XLU 2% down, IYR 2.23, XLP really taking it down 4.7. Why XLP? A lot of the components in XLP are global, and you have some shipping channels that are simply just blocked, which means good luck getting anything in there, including all of the staples that they need. Food. SPY down 2%, IWM 4%, 1.24 on tech. TLT. Even TLT being thrown out saying, we don't even want this. I can understand that. A federal judge has ordered the administration to refund the $160-some billion of tariff money that it collected. Hundreds of billions pouring in, but only 100 of billion collected. I wonder where it all went. Hundreds of billions pouring in, but only 100 of billion to be paid back. Well, 1.6 hundred of billion. Do you think? I don't know. Well, I don't want to just say that the president lied about that. Maybe hundreds of billions did pour in, he just stole it. So he's either a thief or a liar? You pick. ZQ, this was just frustrating for the whole week. The May ZQ ended at 96.865. The week before was 97.07. It had lost at 1.33 basis points. I upped my position again to 600 contracts before the jobs report because I thought this is just stupid. This is stupid. And ZQ quickly priced in like 10 more basis points. And then Bloomberg slowly started talking everyone out of it, if you were listening, talking everyone out of it. And sure enough, they all disappeared again. Even after that number, they all disappeared again. Mike McKee doing his best to talk the market out of any kind of rate cut. Well, they're going to have to raise rates. Everything's inflationary. And then throughout the day, ZQ did return some of those basis points. Some intelligence did come back in the market. But we are pricing in less than 2 rate cuts to the end of the year. Powell's there 2 more meetings. I can see that with Powell, pricing in no cuts with Powell. I can see that. I just don't see that leadership and the culture that leadership has created. I don't see them looking forward at all. I see them looking down at their piece of paper and looking back over their shoulder at where the data has been, all the while saying these things work with a lag, but refusing to look forward like they've always done. I sort of agree with Warsh on this one quite a bit, that the Fed has lost its way, that it has lost its focus. I expect the first cut to come in Warsh's first meeting, if not 50 basis points, but absolutely the first cut. And the July ZQ contract is pricing in, hand-wringing over this too, hand-wringing to price in 9 basis points and hand-wringing over it. It's like should we? I mean, should we? Let's go to 10 and then no, let's get back to 9. I don't know that I've ever seen a market so bloody wrong on this one. Actually, I have. Beginning of 2024, ZQ was pricing in 7 cuts in 2024. I don't know if any of you can remember ZQ at that time, but I brought it up saying this is ridiculous. There's simply just no way. This is absolutely ridiculous. The market is mostly wrong. It's mostly just wrong, and the market is completely wrong on this one. You go all the way out to May of 2027, 50 cuts, 50 basis points of cuts. That's two in 10 meetings. Here's where Warsh takes over. This is Powell. I can understand putting 0 there because this is not a committee of imagination. But this is just ridiculous. Less than 2 cuts. 5 of these 7 meetings are with Warsh, and you're only going to get less than 2 cuts, I think is ridiculous. Real yields, all of them up over the course of the week, and on the last screen we did see DXY up 1.4% over the week. Higher US dollar, higher real yields, negative for metals, gold showing it there, down 2%. Silver really taking it to the extreme, down 11, almost 11%, 10.6. Copper down 3%, platinum, palladium down as well. Only aluminum bucking the trend, but that is hugely energy intensive to make. So the price of that would have to go up. More than likely, China is curbing production on aluminum to conserve energy. Break-evens all higher as well. This really frustrates me to no end, is that you had the market last week thinking that, this will be quick, and Trump says he'll lower the price, and we had a rally one day, gave it back the next day, but the market just is so willing to give inflation all the benefit of the doubt. Let's price that in. Let's price that in now. Get it in there. Well, Warsh said he'll cut rates. We can't price that in. We can't give him any benefit of the doubt whatsoever. Do you sense the frustration in my voice at the willingness of the market to price in something like this fast, but not price in something that somebody clearly said with their own mouth? Anyways, metals all pull back, but year to date they're all up. this is where the administration, I think, is not having a good time. Energy and food, affordability. And that mortgage rate back up to 6%. No, it doesn't have a 5 handle anymore. But look at oil, 35% in a week. And the belief is that this is not done. This is not done. So $100 this week for West Texas. Brent probably up 58% year to date. Gasoline coming along for the ride as well. If you look at the chart of this, you can see it just right up the side of the chart. Same with gasoline. You look at it over the course of the year, just sitting around 213, and then right up the side of the chart. Nat gas coming along as well, 11% almost, still down for the year, but 11% over the week. Food, not having a good time with food. Wheat up 20% year to date. Corn, that was negative, now is up 1.6% year to date. Soy up 15% year to date. Pork up 12% year to date. It's only March 7th here. Year to date, we're only talking like 70 days year to date. Beef up 1.7%. So food is going to cost you more. Gasoline is going to cost you more. That is not helping their chances for the midterm. But at least you could say that the administration did not bring you into any foreign war. Well, no, you can't say that. But what you can say is we can talk about the generosity, I think, of the American taxpayer for footing the bill for this. I think we can clearly see Israel's fingerprints are all over this. This is Israel's war, but the U.S. taxpayer has stepped up and said, we'll take care of the tab. We'll pay for that with money we don't have, for an enemy that really wasn't ours, for a war we never really wanted. Don't worry about it. We got this. Oh, and while it's going on, we don't mind paying higher food costs and higher energy costs at the same time. Every time I fill up my car, I'm going to say to myself, don't worry about it. On us. And we can add this to the debt as well. $1 billion a day. Estimate is that all said and done, somewhere around $200 billion of U.S. taxpayer money. That is generous. That is really generous. When you're done with all of that, we have some infrastructure projects up in Canada that the taxpayer is going to have to pay for. If you wouldn't mind picking up the tab for that, that'd be great. March 18th, FOMC. We get summary of economic projections. Are they going to mean anything? They're more than likely going to be a Powell-fed economic projections. I think we can discard them. I don't know if anyone on the committee will have the foresight to begin to think about what a Warsh-fed might look like and what a change might be. So I think we could just say these are going to be just meaningless. 10 days, 95.5% of no cuts. 95.5, what we saw on Friday after the jobs report. The market collectively said, well, now that we have a negative number, last week, 92% probability of nothing. Let's really go 95 now that we've seen this number. Like not even just a wiggle the other way going, well, maybe, but no. Inflation, which, this is headline. This energy and food, headline inflation, that will drive up headline inflation. Core is a different thing altogether. However, I am aware that the longer it stays, the more it will find its way into core. So let's price that in now. Let's give it all the benefit of the doubt, right? Powell's last meeting, no cuts, went from 75% up to 81%, over-indexing again on inflation. Warsh's first went from 42% no cut up to 54% no cut. This is where I have to draw the line and say, okay, now we've gone from a market thinking that, well, we know what Powell's going to do. We know what he's going to do. He's going to over-index on inflation. But this just crosses the line into stupid, and I'm going to spell it for you because stupid is spelt with 2 O's when you're talking about this level of stupidity. Reverse repo, 1.5 billion. Repos, nothing. Reserves, 3 trillion. TGA 846. SOFR being well behaved, 3.66. Effective federal funds rate 3.64. So no stress showing up there yet. Mortgage apps for February 27th up 11%. Given what we have going on now, given the pressure we're going to see in the food aisles and at the pumps, I imagine a pullback in consumer spending, especially in discretionary items. I think next week and the weeks following, mortgage apps are probably going to start printing negative numbers again. OAS, look at this year to date. Starting to show a little bit of concern with everything we've been hearing in the private credit space, that there is some concern among credit investors of, we're at like multi-decade tightness on these OAS. Maybe give a little. So year to date, it is down. Triple C down 72 basis points, sitting at 9.27 now. And we're going to take some time, and we're going to look into this private credit issue and what's going on there. And it was confusing to me. I thought there was one issue, which was the concentration of private credit by some funds in the software space and the scare that AI is presenting to the software space. But it is actually two separate stories. There is a fundamental layer that you have to know first, and then this sits on top. So when this sits on top of that fundamental layer, the problem gets a little bit more scary. Okay, let's look at Oracle here. This is one day. This is Friday. Look at that big red bar down. This is a big deal. This is a bigger deal than most people think, and I'm surprised it's not getting more airtime. I've said that the biggest threat to the AI story is a pullback in CAPEX, because you get a pullback in CAPEX, a lot of that long tail, the infrastructure story, will collapse very, very quickly. That would be connectivity, anything to do with data centers, anything to do with the energy production and energy supply to data centers, anything to do with cooling, anything to do with memory, anything, all that whole space just begins to collapse. And that started at 3:05 to 3:10 on Friday afternoon with this announcement from Oracle. OpenAI and Oracle, they are going to curtail their data center expansion in Abilene, Texas. And at the same time, there is Credo, there is Astera. You can look at Bloom Energy right at the same time. Huge drop. Look at SanDisk, look at Micron, Seagate, Western Digital, all of them huge drops. And I've got some numbers for you. Bloom Energy, 14.4%. Ended Friday down 14.4%. That loss came 3:05 to 3:10. Every chart took a big step down. Micron down 6.5%. SanDisk lost 7%. Seagate 4%. Western Digital 5.5%. Cipher almost 10%. SEI 3%. And SEI was strong that day on an upgrade. Had 2 upgrades that day and was strong and gave it all up. This is the biggest threat to that long tail. That whole infrastructure tail to AI is a pullback in CAPEX. I said more than likely Oracle would be the first. I love it when a plan works out. Oracle was the first. I don't expect this to be the last one. I expect to hear more pullbacks in CAPEX because of elevated memory prices, because of supply chains that are having a big issue right now, simply because of what is going on in that part of the world. Elevated energy prices right now. It would be prudent, just simply prudent, to have a pullback in CAPEX. Not an elimination, but a pullback, enough such that that 5% memory deficit that we had this year disappears. Memory prices collapse because they're held high, simply because if you want this stuff, you got to buy memory. There's a shortage. The prices just go straight up. Also, Bloomberg and Reuters had reported, this is not confirmed by the company, 20 to 30,000 job cuts beginning March 2026 for Oracle. to deal with their AI cash needs. This would produce $8 to $10 billion worth of cash flow because they got to come up with cash somewhere. Well, they need less cash now, and if they carry through with this, that preserves quite a bit of cash as well. But this did not help Oracle at all. Look at that. Be careful in this space. Be careful in all this whole long tail. I've highlighted a number of these companies over the last couple of months that are supplying the infrastructure story. I don't think the infrastructure story is dead, but it certainly is in need of slowing down a little bit, and it certainly has covered a slowdown now, given what's going on in the world, given what's going on with energy prices, with supply chains, with memory. It certainly is worth pulling back maybe 10 or 15%. Let's not forget, when they announced those big CAPEX deals, they got punished by the market. Many of them haven't recovered. They got punished by the market. That if they pulled back, if they just said, look, we're going to pull back 10 or 15% this year, that's all. And we're going to throttle back the free side by 15%. Cut back your CAPEX 15%, throttle back the free side. They don't get 30 searches a day. Maybe they get 24 searches a day, and that's it. I think the market would reward that, because if you continue on with this, you are massively overpaying for your CAPEX right now, and with energy prices, massively overpaying for your OPEX. You're never going to make it back. So this was probably a good move on Oracle's part. This is probably a good move as well. I don't think that's the last one. I would be very careful in that long tail infrastructure space, because this is the big threat, the big driver to those companies' stock prices is not AI, it is CAPEX. It is the CAPEX for data center space. You get even a 10% pullback, you can get 30, 40% pullback in these stock prices. Okay, let's look at S&P 500. I think there's only one story this week that matters, and that's what's going on in Iran. Headline that I saw just now from CBC: Israel hits a fuel depot in Iran and a hotel in Beirut. And Iran is getting closer to naming a successor for the Ayatollah. So they're pushing ahead with their own decision of who leadership would be. So this is not over. That's going to be the big deal for the market going forward. I don't think really much else happens. But in the backdrop, you have higher energy prices, which are going to start to affect consumer confidence. You have an AI infrastructure play, which looks ripe for a pullback. You have private credit, which is beginning to grow a little. We're going to talk about that. You know, if you talked about Enron, you have to talk geographically about the state of California, and you have to talk about the structure of the SPV, because everything connects there. You talk about the great financial crisis, you have to talk about subprime mortgages and the CDOs, the collateralized debt obligations, and all of the variants of the collateralized debt obligations. For private credit, if this turns into something, which it does have the very real potential to, everyone will be talking about two things: Bermuda and something called funded reinsurance. We'll get to that in a little bit, but let's look at our S&P. 4-quarter operating earnings, $315.89. Some of that may have to come down in some sectors, and some of it will go up in other sectors. Consumer discretionary and retail will probably be a little bit lower, but their loss is energy companies' gain. This is a wealth transfer from the mall to the pump. Closing SPX 6740, you have a 21 times forward multiple on the S&P. Still, considering the backdrop of what's going on financially, employment-wise, and geopolitically, that's still a very rich multiple. And that multiple probably is higher if we consider that this might be overestimated. Lots of volatility, though. 97th percentile for the last 13 weeks. All-time high, still in play for everything. S&P down, you'd think it'd be down more, 3.5% from all-time highs. IWM worse, down 7%, and both IJR and QQQ are more than halfway, a little over the halfway mark towards a correction. A correction on S&P would take you to 627.44. That's down 10%. Not unrealistic. The S&P has lost the 50-day moving average, which is 687, ended at 672. Has lost the 100-day moving average, which is 681, almost 682. You're about $10 lower than that. 656 is the 200-day moving average, which is $16 away. That's in testing territory. You could test that Monday, maybe even Tuesday. 627 is your 10% pullback. Implied volatility last reading 22.1. Watch the VIX. The rotation point's usually 32. That once you get much above 32, usually is a contrarian play. You would start thinking about risk reversals on the S&P 500. LSEG, 7 companies reporting this week. I don't think it matters. Tuesday's your big one. Oracle. There we might get the confirmation on the job cuts for Oracle and a little bit more color on the pullback in Texas that they've done and what their CAPEX or updated CAPEX is. If they can pull back their CAPEX, 10 or $15 billion, if the job cuts result in $8 to $10 billion of savings and they don't need to raise $50 billion externally, you could see a nice pop in Oracle stock. Campbell Soup on Wednesday. Thursday, Adobe, Lennar, Dollar General. Okay, let's talk about private credit. This has been a puzzle in my head for a couple of weeks now. I get that there is some concern about software companies and the concentration that some funds like Blue Owl has towards software companies, 70%, and that AI is causing some repricing in the public sphere, so would be natural that it would cause that in the private sphere as well. But these are marked to model, not marked to market. We're going to go through the incentive structure here part of it will go through the incentive structure for private equity and private credit. There is very little motivation to mark loans less than 100%. It would just hurt their fees. There's very little motivation to get that done. It depends on who's holding the debt. And when you see who's holding the debt and who's in control of everything, you start to then put the picture together saying, oh, wow, I understand the structure now. This could potentially be a big problem. We have to talk about 3 things first before we talk about any issues with private credit itself. We're all hearing redemption gates being hit. That's a natural reaction from the marketplace. Some funds, some loans being written down to zero. Some funds having to throw in some extra money to cover some shortfalls. But it really comes down to how all of this has been structured over the last little while. It was the insurance part that troubled me. So I don't know if you're like this, but if you get a puzzle in your head, I can't let it go. I watched one of Steve Eisman's pods where he had an insurance guy on talking about all of these issues, and I thought, well, this is a smart guy. He can't just be a lunatic in his field. He can't just be making this stuff up. But I didn't understand much of what he said. As I was listening to it, I thought, okay, well, I'm lacking a lot of the accounting background, so a lot of what he was saying was, okay, I catch a bit of this and a bit of that, but I'm missing something here. This doesn't sound like it's enough. I asked on Discord, I got some explanation. I thought, well, that gets me a little closer, but I'm still missing something. And whenever something doesn't fit together, it's a piece of the puzzle that you're missing. So it wasn't just one piece. It wasn't the fact that these private equity funds started buying these private credit platforms and owning insurance companies. That wasn't enough. It was like, but it's an insurance company. It still has to follow regulation. But when you combine a different jurisdiction for the insurance company, you change the risk-based capital that it needs to hold. So the Bermuda piece started to make a lot more sense, but still, it didn't quite really make all the sense. I'm still missing a piece. These are reinsurance companies that are in Bermuda, and a reinsurance company, you just pay them a premium, and it's like buying insurance on your insurance. So I still didn't get it. But you needed something called funded reinsurance to understand this one. And even with that, there was still a piece missing, which was the rating. When you have all 3 pieces, Jurisdictional exploitation. This is where Bermuda comes in. When you have the structure, the financial engineering structure of a funded reinsurance vehicle. This one here is pretty interesting. And then combine that with credit ratings that are sometimes as high as 6 notches above where they would be if they were rated by the insurance commission, any of the state's insurance commission. There's where the power comes in. I'll show you with some numbers. So let's go through each of them. Why Bermuda? What is funded reinsurance? And what is going on with the rating systems? The last time we saw an issue where the ratings companies decided that they were beholden to the rate, to the issuer as opposed to the creditor, we had the great financial crisis. My slides aren't really that pretty because I was really just making a whole bunch of notes trying to get my thoughts in order. And the puzzle really didn't come together till like Saturday afternoon, where everything fell into place and I said, I see it now, I get it. So I made up a whole bunch of bullet points and I just put them on a PowerPoint. I didn't have time to do anything for it. Let's start with an insurance company. So you have these private equity platforms, BlackRock, KKR, Blue Owl. Many of them bought private credit platforms. They also own insurance companies. And all of this is domiciled, let's say, in the U.S. So the insurance companies in the U.S., this was the first puzzle is, so what? I mean, so they own an insurance company. The insurance company is highly regulated. So what? I don't get it. U.S. very rules-based. But Bermuda uses something called principles-based economic balance sheet approach. It allows the insurers to use their own economic assessments of liabilities, subject to regulatory review, but they can use their own assessments. In the U.S., it's like, here are the rules. You follow the rules. If you have this kind of type of liability, here's the discount rate you're going to use, here's the term you're going to use, here's the assumptions you're going to use, here's the mortality rates you're going to use. Everything is given to them. You're going to use this. It's very formula-based. In Bermuda, it's like, well, we think it could be this, and we think it could be that, and you can come up with your own. It has to be reviewed, but you can come up with your own. Permits practices that U.S. rules prohibit or severely constrain the ability to hold negative reserves on one product line and net them against positive reserves on another. This requires a little bit of a description. Let's take a balance sheet, and let's say you have a liability and you have assets, and in this particular case, the assets, let's call them 100 and the liabilities are 96. You have an overfunded status, you're good. And this is a particular line item for a particular type of policy or group of policies. Let's say this is pension fund number 1. These are the annuities for pension fund number 1. Okay, great. Let's say you have pension fund number 2, where it's the opposite, 96, and this is the annuities for pension fund number 2. In the U.S., you have an issue right there. You get no credit for this, by the way. You're good there, but you have an issue here. Whereas in Bermuda, you can net them. 196 versus 196, and you're good. Not in the U.S. You can't net them. But in Bermuda, you can net them. Greater flexibility in determining which assets qualify to back reserves and at what valuation. Read that again. Not only can you net them to lower the amount that any deficit that you may particularly have, but you then get a lot more flexibility in determining what assets you're going to use and at what valuation they're sitting on your books at. Bermuda now accounts for approximately 1/3 of all ceded life and annuity reserves from the United States. Not 1/3 of all life and annuity reserves, of all ceded life and annuity reserves. So let's just put insurance in your head here for a minute. You have a house. I'll draw the house as neatly as I can here, and let's say you just have a doorway and you only have one window. You couldn't afford a big house, and you need insurance on that house. You call an insurance company and you pay the insurance company a premium, and the insurance company assumes the risks of that house, and there's a statement of what risks it's going to assume. But ownership of this house stays with you. that's your asset. That's your house. You're just paying a premium to the insurance company to insure that risk. Reinsurance works the same way. Let's say this insurance company here has a whole bunch of policies in a particular geographical area. And it may say, you know what, we got way too much exposure here, so they're going to contact another insurance company called a reinsurance company and say, we want insurance on our insurance. And this company will say, okay, well, you'll pay this premium and we will insure certain risks. But the policies and the assets stay with the insurance company. They do not transfer. That's basically how these things work. This part here is called ceded. You have ceded some of the risk. So Bermuda now accounts for approximately 1/3 of all ceded life and annuity reserves from the United States. Bermuda has achieved qualified jurisdiction status under the state's this is for insurance regulators, under the state's insurance regulators framework. NAIC is the governing body or the overriding body of all the different states' insurance committees. So they say Bermuda is a qualified jurisdiction, so there's nothing illegal here. It's not as if setting up a reinsurance company in Bermuda is illegal. The NAIC says, yeah, that's fine. They just have a different way of looking at things than we do, but we're okay. The parent effectively determines how much capital to hold against the liabilities it manages. The parent also manages the investment portfolio of the Bermuda reinsurer, originating and selecting the private credit assets that back the liabilities, and the parent earns management fees on those assets. So there's little incentive to mark to model below 100%. So you have, we're going to get into more detail about why you would use Bermuda. How come you're doing this? The reason is you have to hold so much capital in the U.S. Capital is how much equity you have. That drops significantly when you get to Bermuda. It is more capital efficient for the private equity firm. Now, you have this portfolio of private credit loans, and some of them are in trouble, but it's marked to model, so you always put them at 100%. Why? Because the fees you charge the investors are based on the assets under management, the net present value, so there is little motivation to say, well, this loan probably would sell at 96 cents on the dollar if we tried to sell it. If you write it down to 96, you just shoot yourself in the foot because it's your fees. Now, you own the insurance company who ceded the assets to the reinsurer that you own. You made the private credit loans. Since you own it all, you're only lying to yourself. So there is little motivation to price these at less than 100%. Okay, let's move on to the structure, the funded reinsurance. Remember what I said on the last screen? You simply just pay a premium. The insurance company would pay a premium to the reinsurer, and the reinsurer would say, okay, well, we'll cover you for certain risks. However, all of the assets and all of the policies stay on the insurer's books. In a funded reinsurance, they move to the reinsurer. The policies and the assets move to the reinsurer. The insurance company now has some cash in which it can either write more policies or, because it's owned by private credit, return that to the private equity, private credit platform. So the cedent, this is the insurance company in the U.S., transfers not only the longevity risk, this is for annuities, not only the longevity risk, but also the investment risk. This is the Apollo Athene capability. Apollo owns Athene, a U.S.-based insurance company. Athene writes annuities and pension risk transfer business onshore in the United States, as do all insurance companies. A pension fund may come to them and say, you know what, we have a surplus. And rather than run into trouble right now, because a lot of pension funds ended up with a surplus over the last few years, you had rising interest rates, which means the PBO, the benefit obligation, present value of the benefit obligation is lower. Your equity portfolio is significantly higher. A lot of pension funds have gone into surplus, and they're saying, you know what, let's move this off our books right now. Let's go to an insurance company and buy these annuities and protect ourselves right now because we have the money to do it. And the insurance company says, yeah, we'll take your money. So they are in the United States. Athene then cedes a portion of these liabilities to its own affiliated Bermuda reinsurance subsidiary, which are captive entities within the Apollo corporate family. Apollo's credit platform originates the private credit assets. The captive Bermuda reinsurer holds those assets against the ceded liabilities under the lighter EBS capital framework. So the entire chain, origination, insurance, reissuance, is internal to Apollo. Plus, the cedent can also be a third party. So the Bermuda reinsurer can also act as a third party. It doesn't have to just take what Athene gives it. It can go out and say, hey, is there any other pension fund or insurance company that would like to do this? Well, it's reinsurance, so it would be another insurance company. And turns out there are other insurance companies who say, yeah, we'll use you. Another insurance company altogether. Means the private credit exposure embedded in the insurance system is not limited to the insurers that the alternative managers own. It extends to independent insurers that have entered the funded reinsurance relationships with alt manager affiliated reinsurers. So these are sitting in Bermuda. You can then transfer your assets and your liabilities to Bermuda, but so can another insurance company that has nothing to do with this company. Now you're thinking, well, what's the big deal? The assets and the liabilities, what's the big deal? If it's in the U.S., you have the liability. Let's do the balance sheet. You have the liability, which is the annuity, and you have the assets, which are more likely government bonds or investment grade bonds. And let's say that you need a certain amount of capital for this. So you have your liabilities, your assets, and your equity, and this is how much equity the insurance company would have to hold against these, and these are all risk-based. So if you went from this stuff here to private credit, the amount of equity this insurance company has to hold would increase dramatically. But not if you sent it to Bermuda and you valued it differently and you had it rated differently. Chances are the amount of capital you have to hold would drop significantly. And you have to transfer the assets. Well, here is the private credit fund. The assets go to the private credit fund. The private credit sends private credit loans to the reinsurer. It then sells all of these government bonds and IG bonds for way more than the value of the assets it transferred. Isn't that beautiful? So you had, hundreds of billions of dollars. I sound like Trump now. Hundreds of billions of dollars pouring into our country, pouring into Bermuda. Which means that hundreds of billions of dollars of private credit loans were showing up there, which means hundreds of billions of dollars of government securities could be sold. I wonder if that's what was keeping up the long end of the yield curve for so very long. Well, you can do this. All of this can be done with another insurance company. So another insurance company comes to the reinsurance company and says, here's our liabilities, here's our government bonds. And the private credit fund steps in and says, we'll take these government bonds and in its place we'll put far less face value of private credit because of course it earns a higher return, and then we'll go and sell these and we'll take this cash and we'll go issue more private credit loans and we'll just keep recycling that money. UK bulk purchase annuity market has become the primary arena for the funded reinsurance. Up to 30% of annual BPA premiums, equivalent to about 3 or 4 billion pounds annually, are now ceded via funded reinsurance going into Bermuda. The concentration of funded reinsurance. The market is not served by dozens of diversified, well-capitalized reinsurers competing on price and quality, served by a handful of specialized vehicles, each affiliated with a major alternative asset manager, each following a similar strategy, each domiciled in the same offshore jurisdiction, and each subject to the same principles-based regulatory framework. Huge concentration, not only in the firms that are doing it, but in the geography and the structure that they're using. So if you get a problem that hits a huge concentrated strategy like that, what do you think happens? Let's look at the next screen here. Life insurers in the United States are subject to risk-based capital requirements. This is where we're going to see exactly how much reduction in capital we can get by moving the same liabilities from U.S. to Bermuda. The risk-based capital system assigns a capital charge to every asset on the insurance balance sheet calibrated to the asset's credit risk. So if you hold a 10-year U.S. Treasury, you have to have so much of your own equity in the company. You have to say, well, if that is your asset, then it has to be backed by maybe $2 of equity or $3 of equity for every $100 that you have, something like that. The higher the credit risk, the higher the capital charge. Well, that makes sense. The more surplus the insurer must hold to absorb potential losses on that asset, because the capital that you have, the equity that an insurance company has, is the first loss tranche, not your policyholders, but the equity. The riskier the assets you hold against the policies you hold, the bigger the capital you have to absorb the losses. That all makes sense. In the U.S., the policy is designed to protect the policyholder, not the insurance company. The capital charges are tiered by credit rating, using a classification system that maps directly to the familiar letter grade scale, and there you have investment grade and high yield. You have 10 and 10 ratings across these. When an insurer holds an unrated private credit instrument, an insurer now in the U.S., and needs a rating to determine its risk-based capital charge, the insurer can obtain a private letter rating, which is a rating issued by an NAIC-recognized credit rating agency, disclosed only to the insurer and the NAIC, not published publicly. Why? Because it's private. That's the whole point. It's private. It's none of your business. As long as a regulator knows it and the insurance company knows it, and they have $1 million of that asset on their balance sheet, they know how much capital they need to hold on their balance sheet as well. The private letter rating market is dominated not by the major agencies, but by smaller specialized firms. These smaller agencies hold approximately 86% of the market share in the U.S. private credit ratings. Major agencies only account for about 14%. Here's where the problem creeps in. Smaller credit rating agencies frequently sign ratings up to 6 notches higher than the NAIC's own securities valuation office baseline assessment. 6 notches is not a marginal difference. Spans the entire distance from sub-investment grade B to solidly investment grade triple B. So this is an investment, this is high yield, and there's this cutoff here. And the risk-based capital tends to increase the lower you go in investment grade, but then really jumps from the lowest investment grade to the highest high yield. There's a big jump in risk-based capital that you need. Well, if you can get your loan from here just into here, you lower the amount of capital that you need. Well, that's where this comes in, right? A 6-notch upgrade from B to triple B produces approximately an 84% reduction in the pre-tax risk-based capital charge for a life insured. Let's put that in numbers. An asset that would require the insurer to hold $8.40 in capital for every 100 of exposure at a B rating requires only about $1.30 at a triple B rating. So you do truly have a B-rated private credit loan that's sitting on the insurer's books as an asset. Should hold $8.40 against it. But you have one of these ratings where suddenly it's investment grade, one of these smaller credit ratings, suddenly it's investment grade. You now only need $1.30 of capital to absorb losses. But the real reality is that it's riskier than a triple B. It is a B. You are going to experience these losses, and $1.30 is not going to be enough to protect the capital, which means the policyholders are going to get hit unless the sponsors, these are KKR, Apollo, Blue Owl, unless they then sell more shares to recapitalize their insurance companies. It gets a little bit worse. Let's keep going with this one here. We're almost done. 2 more screens here. The credit rating agency is paid by the issuer or the arranger of the private credit instrument. So Apollo, one of their credit platforms, issues a private credit loan, and hires this credit rating agency to give them a rating. But they're paid by the issuer. The credit manager has direct financial interest in obtaining the highest defensible rating. A higher rating means lower capital consumption on the issuer's balance sheet, which means the insurer can hold more of the manager's originated assets, which means more fee income for the manager. So I want the highest rating I can get. There aren't just 3 rating firms. This is dominated by the small credit rating agencies, so I'm going to, quote, shop around. And if you're one of these smaller credit rating agencies, you're going to argue, look, if we always keep giving a low rating, we're never going to get any business. We better play along here if we want to make some money. The The credit rating agency in turn knows that if it consistently assigns ratings lower than its competitors, the issuer will take their business elsewhere. The competitive dynamic creates a gravitational pull towards higher ratings, not necessarily fraudulent or indefensible ratings, but ratings that systematically occupy the upper end of range of reasonable assessments. So let's go all the way through this. Private credit issues a loan to a business. That is the borrower down here. And that borrower is already highly leveraged. 4.9 to 7 times EBITDA is the level of their debt to EBITDA, which is fairly high. They're already leveraged. Then it sells it to its insurance company in the U.S. That has annuities. But this is going to require a lot of risk-based capital, unless you can get a nice rating, and they do get a rating which lowers it. So once they build a big book of this, they can then go to the reinsurer that the private credit firm earns and says, okay, well, we're going to transfer all of these liabilities to you, and we're going to transfer all of these assets to you, which lowers the amount of capital dramatically that is needed over here. And this also lowers the amount of capital because you can value this not as you see fit, but you have more leeway to value it, and same with valuing your liabilities. More than likely, when annuities hit the insurance company over here, the assets, to maintain a low amount of capital, the assets were originally investment grade bonds or government bonds. And when they got large enough, these were transferred to the private credit firm, which then transferred the private credit loans to the reinsurance company, and all of the liabilities were transferred down there. So the capital that is required throughout the whole system is extremely low. But this loan is to a highly levered firm. Now, the fund level, the fund itself, the private credit fund, could also be levered up to 2 to 1. Blue Owl, I think, is 1.26 to 1, meaning it has $126 of debt for every dollar of equity that it has. There are also NAV facilities where you can draw more money from. Subscription lines, this is the uncalled amount of money, especially for a call-down fund. And then the insurer capital, the leverage, this is if we think about the reinsurer, if you look at all of the leverage throughout the system, the reinsurer is leveraged somewhere between 7.6 to 12 times. This is called the ghost leverage stack. Why doesn't anybody do anything? Is because at every level, it's a different regulator and a different view. A regulator at one level says, well, this is not my purview. I don't, that goes way beyond what I normally would look at. So all along the way, every regulator says, yeah, we're okay with all of this, but when you put the whole thing together, I don't think there's a single regulator out there that would say, oh, we're okay with the full aggregate picture. None of them are okay with the aggregate picture, but none of them have a purview for the whole thing altogether. Let's deal with the idea of recapture. So we've explained the process of going from the U.S. to Bermuda and how you could really reduce the amount of capital that is required to fund the balance sheet, and you could put all of your private credit debt into here and remove it off the U.S. balance sheet altogether. What about coming back? Under what conditions would you say, well, okay, now all of this has to come back, and if it has to come back, all of that has to unwind, which means the private credit shows up here. You need huge amounts of risk-based capital over here. More than likely, you'd have to sell this loan and buy U.S. Treasuries or buy investment grade to lower the amount of capital. All of it would have to unwind, and then you'd have this big sale going on in private credit loans. What would cause that to happen? That scenario, by the way, is called recapture. The scenario begins with a deterioration at the offshore reinsurer. The stress could originate in the private credit portfolio, whether they be defaults, marks down, liquidity problems, in the reinsurer's own capital position, or in the reinsurer's relationship with its parent. The stress could also be triggered by a ratings downgrade of the reinsurer itself. Whatever the trigger, so I gave you a whole bunch of issues. Whatever the trigger, the consequence for the cedent, this is the U.S. insurance company, the consequence for the cedent, the onshore insurer that ceded the liabilities, is the same. The cedent must recapture. You've got to bring that liability and that asset back. You must recapture it. But now, When the liability left, it was a different asset backing that liability than when it's coming back. It was either an investment grade bond or a U.S. Treasury, but now it's a troubled private loan. So the amount of capital the insurance company needs to back that when it comes back on is going to skyrocket. It's going to have to issue equity. It's going to have to issue shares or be recapitalized. The easiest thing to do is just to sell that private credit loan, take whatever money you can, and back the liability with assets that require less capital. The cedent must recapture. Recapture means the liabilities returned to the cedent's balance sheet along with the assets that the reinsurer was holding back then. An asset that consumed $1.50 of capital per 100 of exposure in Bermuda might consume $5 or $8 under U.S. risk-based standards, depending on its rating, its structure, and its classification. You end up with solvency issues. You end up with all of these insurance companies that are now insolvent because they're getting the liability back. They're getting a completely different asset back, and the regulator is saying, well, you don't have enough capital. You're going to have to do something. You got to recapitalize. You're basically insolvent at this point. PICs make this worse. Now, a PIC is a payment in kind. This is a growing problem, one in which the private credit fund and the private equity sponsor of the company that owns the company that has the private credit loan has really no motivation to solve. So a PIC is a payment in kind. Let's say you have a company, and we'll call it ABC, and that is making interest expense to the private credit fund, and it's running into trouble. We've had interest rates rise over a period of time, so its interest expense as a percentage of its EBITDA has increased. Maybe it had a coverage ratio when it first started in 2021, 2022 of maybe 3 times or 4 times. Might be barely 1 at this point in time, meaning that most of its EBITDA is consumed with an interest payment. Enter CoreWeave. So they're having trouble meeting all their expenses and the interest payments, so the private equity firm that funded the company and the private credit firm that funded the company in association with the private equity firm, and usually these are the same ones now, says, well, I'll tell you what, rather than pay us cash, why don't we just add it to the principal? And then next month you'll owe us interest on the principal plus interest. You'll pay us in kind with just another interest payment. The return on the fund looks the same. You got an increase in the asset. You got your interest expense, which was a payment, but you added it to your assets, so your asset amount is higher. So your assets under management just went up. And you charge all of your investors a fee based on assets under management. And you're marking that loan to model, which is 100 cents on the dollar. Now it's 100 cents plus the interest component because, well, there's no motivation to mark it down to 96 because your fees would drop. And who are you charging your fees to? You're charging your fees to the very insurance company that you own. So why would you ever mark it down? So you have all of these PIC payments happening, and those have been increasing over the last little while. So you get to a point where the ABC can no longer move forward. Well, now you have a problem. So the loan that becomes a problem is even a bigger problem because you've let it go for so far that when you do have to bring it back, the amount of capital you need is significant. That is the first stage that you need to know. That is the structure of what's going on out there. That is Bermuda, and that is funded reinsurance backed by credit ratings that are aggressive, and that any stress on here could trigger a recapture. Now, let's go up to Blue Owl, and we can begin to see the problem that this will start. Investor concern, AI disruption. So that we're seeing it in the private market, in the public markets. Why wouldn't it be the case in the private markets that some of the valuations of these companies might be in trouble? So you get the start of redemptions. Is people show up and say, I would like this much money back, and I would like this much money back, and I would like this much money back. These semi-liquid funds usually have a 5% gate per quarter, and they've been exceeding that for some time. So Blue Owl took a different path and decided, well, let's get rid of the gate, and you're simply just going to get the money back when we sell the assets. Others have said, no, we're sticking with our 5% gate. Others have said, look, we'll meet the redemption this time at 9% or 8%, but we're sticking with the 5%. We're sticking with the 5% gate. What's going to happen is if your redemption is not met, and you're seeing that redemption is not met, for the next one, you're going to double the amount that you want. Arguing that, well, I'll only get half of what I asked for, so I may as well double the amount I want. Somebody who didn't want anything says, better safe to get in line than to not get in line. So the next quarter, the redemptions are going to be even bigger. And everyone's only going to get a percentage of that because you're sticking with 5%. So now I know that you're only sticking with 5%. I'm going to ask for all my money back. I'm going to ask for everything back, and I'm going to try to get as much as I possibly can so the redemptions start building as well. Blue Owl sold $1 billion worth of loans at 99.7 cents to make a point that they are marking to model at 100, and they were able to sell 1.4 billion at 99.7% of that, basically almost 100%, saying, see, look, there's a public market for this. What sort of throws it into doubt is the insurance company that they own was a buyer of some of it. We just went through that, right? Where do you think that stuff is going to end up? That stuff's going to end up in Bermuda somewhere, right? So there's the problem with the concentration. Blue Owl is receiving these redemptions because of its concentration in software, which is under pressure. And remember what we said, that if there's stress in the Bermuda portfolio, if something is impaired down there, it's going to have to be recaptured, which massively increases the amount of capital that you need. And then we've heard of some other write-downs in the private credit space and some frauds in the private credit space. And you wonder, well, how good are these companies if they keep getting hit with fraud? It's because no one company ever sees the whole structure. They only see pieces of the whole. So fraud is easy, or easier, to start putting in there. Once you have these vehicles that are opaque, all sorts of funny things can happen in there. So the end result is, who knows how much exposure is in Bermuda? Who knows how little capital is there? Who knows how much of that is under stress? And who knows where it's held? Making matters worse, some of this stuff is packaged in wrappers. That means that you can take some of this private credit, you wrap it up in a CLO, collateralized loan obligation, you can mix it with some other CLOs, and you could put it into another security that you can then tranche as well. This is what Apollo has done with one of their structures. I think it's called Fox Hedge. Is they've taken all of this stuff and they put it into a 40-year bond, and then they put these securities, these 40-year bonds, on the reinsurer's balance sheet. Well, none of these are 40-year loans, but yet they're in a 40-year bond wrapped up in there now. In Apollo's defense, they own everything. It really doesn't matter where it is. They own everything. They're just taking advantage of regulatory capital arbitrage by doing this, but also pushing it a little bit with the credit rating, with the type of loans that are sitting on these books. And in the end, whose money is it? These are all annuities. These are all pension funds who said, look, we're in a good position. Let's get this stuff off our books. Let's go to these insurance companies. And the insurance companies saying, how can we get better efficient capital? I know, let's do this. And down in Bermuda it goes. There are some that are using Cayman Islands. That's even worse as far as the amount of regulation that exists there. It's even lower. It's even more aggressive. But whenever you have this kind of concentration, heavy amount in Bermuda, and the concentration in terms of the number of the players that are playing there, 4 or 5 big platforms, all with motivation to keep the balance as high as possible, because that's what the fee is based on. You get any stress in that thing unwinds. That was the piece of the puzzle I was missing. Okay, so you got some stress in private credit, but there's always stress in private credit. It's not as if it's risk-free. So it's on an insurance company's books, but they're regulated. That doesn't make sense to me. So it's reinsurance, but that I still don't get the reinsurance thing, because all you're doing is opening another insurance policy. I still don't get it. I needed Bermuda. I needed the lower capital requirements. I needed the idea of the funded reinsurance. That's when it started to fall into place. And then when you add the small credit rating agencies' willingness to be 5-6 notches above where it normally is, it's like, oh, this is a ticking time bomb. Potentially, it's a ticking time bomb. There's the problem in private credit. Now you take that, and you take a little bit of pullback in CAPEX for the AI spend, and you go another 1 or 2 weeks on the Iran war, and you push the price of oil over 100, why would we not visit the 200-day moving average? Why would you not have a 10% pullback, right? Anyways, that's the week. I know I probably left out a lot of tiny details along the way. I am eventually going to write this up, and I will add it to the private credit reading that I have up, Understanding Private Credit. I will add it as an addendum because I think it's important, but I am still missing just a few little pieces here and there. By the end of the week, I should have enough that I can then begin to use my favorite AI tools and say, okay, here are my notes. Let's organize this and let's write this up. But I'm almost there. If you think I missed something, feel free to leave a comment. I will read them.